All right, today we're going to tackle a question that honestly trips up a lot of investors, even the really experienced ones. It's a puzzle that gets right to the heart of how the stock market actually works.
So you did exactly what you're supposed to do, right? You bought a total market index fund because you wanted to be diversified to spread your risk across, thousands of companies. But then you peek under the hood and wait a second, a huge chunk of your money is just sitting in a few big tech giants. So what's the deal?
Yeah, let's make this super concrete. Say you put 10 grand into a popular total market fund. Well, something like 600 of your dollars would automatically go into Nvidia. But at the same time, only about 50 bucks would end up in Starbucks. How is that possible? How can a fund that's supposed to buy the total market be so lopsided?
Okay, to figure that out, we have to get our heads around one single super important idea that really drives all of these funds. It's got a fancy name, but the concept is actually pretty simple. Market capitalization, or just market cap.
So what is market cap? Well, in the simplest terms, it's the stock market's way of answering the question, how big is this company? And listen, it's not about how much stuff they sell or how much profit they make. It's just the total price tag that all the investors in the world have collectively put on the entire company.
And you know what? The math behind it is surprisingly easy. Seriously. You just take the current price of one single share of stock and you multiply it by the total number of shares that exist out there in the world. Boom. That's it. That number is the company's market cap.
Okay, so we've got our key concept down, market cap. Now let's connect the dots and see how that one little number basically dictates exactly how your index fund invests your cash.
Let's start with a big one, Nvidia. As of recently, the market, that's millions of people buying and selling, has decided that the whole company is worth a mind-blowing $3 trillion. That number is just huge, and it really reflects how central they've become to, well, pretty much everything in tech right now.
Okay, now let's compare that to Starbucks. I mean, we all know Starbucks, right? A massive global brand. They're on every corner. The market values Starbucks at around $90 billion. Now, that is a ton of money for sure, but it's just a tiny fraction of Nvidia's value.
And when you actually see those two numbers side by side like this, the difference is just, wow. It's not a small gap, it's a chasm. Nvidia's market value is more than 30 times bigger than Starbucks. The market is basically shouting that Nvidia represents a much, much, much larger piece of the American economy.
And here it is. This is the moment it all clicks together with your fund. Your index fund is programmed to just mirror these proportions. That's its only job. So if we imagine a simple little two-stock fund with just these companies, if Nvidia makes up 97% of their combined value, then, you guessed it, 97% of your money goes into Nvidia. The fund isn't making a choice or a bet, it's just reflecting reality as the market sees it.
Now, I know what you might be thinking right about now. Wait a minute, that sounds kind of risky, putting so many of my eggs in one giant tech basket? But here's the big reveal, the twist. There's a powerful logic to this system, and it actually has a kind of built-in safety net.
This right here is the absolute heart of the matter. This heavy concentration in the biggest companies, it isn't a mistake. It's not a flaw in the system, it's the whole point. It's a feature, not a bug.
Yeah, think about it like this. Your fund isn't actively saying, we think Nvidia is a great bet. No way. It's passively accepting the verdict of millions of investors all over the globe. All their buying and selling has collectively landed on that $3 trillion number. The fund is just designed to own the market, exactly as it is, warts and all. And what this does is create this really elegant, almost beautiful self-correcting system. When a company does well and its stock price goes up, its market cap gets bigger, right? So the fund automatically holds more of it. It just naturally rides its winners. And the opposite is true too. If a company stumbles and its stock falls, its market cap shrinks and the fund automatically owns less of it. It cuts its losers. And the best part, all of this happens passively, automatically. No manager has to step in and make expensive trades to rebalance things. And that efficiency is a huge reason why the fees on these funds are so incredibly low.
All right, so we've gone through the what and the how and the why. Let's zoom out for a second and just lock in the big picture, the one key takeaway from all of this.
Look, if you forget everything else, just remember this. Your total market fund invests more in the biggest companies because its goal is not to pick winning stocks. Its only goal is to own the entire market. And to do that, it has to own each company in proportion to its size. So by owning more of the giants, you're simply getting a more accurate snapshot of what the stock market actually looks like today.
So, there you have it. Market cap is kind of the market's default setting, its core logic, all built on this idea of collective wisdom. But it's not the only logic out there, and that leads to a really fascinating question to chew on. If you decide not to invest based on a company's size, what other ways could you do it?